Oil prices increase, dip, rise, slide, surge. Have you seen such headlines in the recent past? Most likely you have, especially when there is a sudden development such as the Russia-Ukraine war or concerns around economic growth in China or more recently military action in West Asia. What's happening in West Asia is worrisome at a humane level. The other question that arises now is what impact will the skirmishes there have on oil prices globally? A look at the history of wars in that region may give us an indirect answer. Hello and welcome back to Business Matters at the Hindu with me, K. Bharat Kumar. There were two developments in West Asia in the 1970s that led to the so-called oil shock in the world. And this fundamentally changed the nature of the oil sector. The first was the Yom Kippur War of 1973 and the second, the Iranian Revolution in 1979. This oil shock led to a humongous surge in oil prices and led to the cartelization already prevalent in the sector more intense than ever before. In 1967, Israel had taken territory from Egypt and Syria, that is, the Sinai Peninsula and the Golan Heights, respectively. This was called the Six-Day War, and Israel found itself having control over new lands that were 4 times its original size. When negotiations to help repatriate those lands failed, Egypt and Syria attacked Israel in 1973 on a day that was most auspicious to the Jews, Yom Kippur or the Day of Atonement, and that is why this was called the Yom Kippur War. When the US decided to help Israel rearm, that didn't go down too well with the Arab coalition, and the then avatar of the Organization of Petroleum Exporting Countries, or OPEC, mostly the Arab states, brought in an embargo on oil shipments to the West, namely to the US, Canada, UK, and the Netherlands. It is important to note that the OPEC grouping, which was founded in 1960, had a market share of 56%, a global crude market share, by 1973, up from 47% in 1965. The US was the largest oil producer during World War II, but by 1973, its industrial expansion needed so much more oil that it became a net importer. In 1973, it was importing as much as 30% of its oil needs. Back to our story. Countries impacted by the embargo scrambled to change oil supply lines and tap oil from other sources. They were eventually able to, but in the meanwhile, the cost shot up humongously. From $2.9 a barrel before the embargo to $11.65 a barrel by March 1974. The embargo was lifted by OPEC after the US prevailed upon Israel to hand back occupied lands to its adversaries. Likely when everyone thought that friction in West Asia had subsided, the Iranian Revolution of 1979 broke out. The Shah of Iran was overthrown by the revolutionaries. A majority of Iran's oil sector employees actively participated in the protests during the revolution, as a result of which oil production plummeted, amounting to an output loss of 2.5 million barrels a day. Prices again shot up due to supply impact. Tensions in the West Asian region continued. The revolution in Iran was followed by the Iran-Iraq War of 1980, and towards the end of that decade came the assault by the US on Iraq after the latter invaded Kuwait, and so on. It is interesting to note that even during the oil shock of the 1970s, the US did not import oil from another major producer, Russia. Compare what happened in 1973 with the situation now. Israel is now intent on avenging the October 7th attack by Hezbollah on the Jewish state. Israel is now fighting battles on several fronts. Iran has entered the skirmish and has warned oil producers in other parts of the world of dire consequences in the event of their support to Israel. It has told oil-rich countries that host US military personnel, such as Saudi Arabia, the UAE, and Jordan, that Iran couldn't guarantee the safety of their respective oil sites if they extended support to Israel. Upon the US's urging, Israel is reported to have given the assurance that it would avoid targeting oil and nuclear sites of Iran, but that it would only focus on Iran's military targets. On this front, imagine if the worst were to happen. That is, if the oil sites of multiple oil-producing nations were to be hit, what would happen to oil supplies? As oil supplies go down, prices would go up. And if what happened in 1973 repeated now, imagine paying 4 times as much for your fuel needs as what you're doing so now. What will happen to inflation that RBI is so focused on bringing down? It wants to bring down inflation to 4%, whereas the September print, for context, came in at 5.5%. After all, The movement of food, our very basic necessity that comes to us from different parts of the country, depends on fuel and fuel costs. If the US can help avoid dire action by Israel and its adversaries, oil prices are likely not going to shoot through the roof. Since the early 2000s, the US's own domestic sources of shale oil have been helping global supplies as well as keeping the price of crude oil somewhat stable. The US is currently the largest producer of oil, a position that we saw it held during World War II. The other point to note is that now, compared to 1973, the sources of global oil have become diversified. For example, when the Russia Ukraine war started, Western countries sanctioned Russian financial systems and corporates. But countries like China and India, which are oil guzzlers, continued to buy more and more oil from Russia, thus helping keep prices of oil down or stable in the minimum. So, the answer to the question, what impact will military action in West Asia have on oil prices, is it all depends on how much the war expands, both in spread and intensity. But analysts seem to be somewhat optimistic about oil prices in the near future. JP Morgan has said that for the quarter ending December this year, oil prices will average $80 per barrel. The US Energy Information Administration estimates that oil prices will average $78 per barrel for all of 2025. Last month, the same institute had said that the average would be $85, which means it is expecting oil prices to drop now and not rise, even given the current geopolitical tensions. One of the reasons could be concerns around economic growth in China. All of this still leaves one more question unanswered. How long can India manage in the unlikely event that the global supply of oil grinds to a complete halt? In other words, do we have any reserves, and how long can these reserves last us? We know that the Indian Strategic Petroleum Reserves Limited is responsible for storing oil in the event of a catastrophic halt to global supplies. The ISPRL is said to be building caverns for expanding storage of strategic oil reserves. Add to this the about 40 odd days of oil supplies that oil marketing firms, HP, BP, and Indian Oil, hold. The IEA had earlier this year indicated that India holds about 66 days worth of oil consumption as reserves. That brings us to the part where we share nuggets of information with you as always. Did you know that Brent crude oil touched a record high in recent times of $147.5 in July 2008? For context, it is currently trading in the region of about $74. Ironically, it dropped dramatically after the global financial crisis hit the markets a few months later in 2008, that is in September of that year. And for the quiz question of this week, here you go. The OPEC is seen as largely influenced by the Arab world, but there is a South American country that is part of this grouping and has been a member since the group was formed in 1960. Which country is this? That's all we have for you folks in this episode. Oil prices is an interesting topic and there's so much to say on a daily basis. But if there is anything of significance that happens that impacts oil prices, we'll be back with you with that update. Till we meet again next week, have a lovely time ahead.